Welcome to my YouTube channel. My name is Phil Grande, philsgang.com. I like to give you things that I think are very helpful that most the fake business network, they just don't give you, okay, that helps you make decisions. Right now they're saying that the market, that the floor is in. That's it. We're done. The rallies is going to start again, that the sell-off is completed at 4,000. Well, that's not true. I'm not going to show you why it's not true. Now, the market, again, is all about probability. There's no 100%. I can't tell you 100% it's not going to drop, but what I'm going to give you for evidence sure puts the probability on the side of this market is going to drop much more. All right, let's do this quickly. I want to go back to 2008, back here. The inflation we talk about today did not start, if you look at my chart, it does not start in this area right here. Okay, it does not start where we had the pandemic 31% stock market drop. Now, we're being told that, and they're saying that's where all this inflation started. No, it didn't. The inflation started back here in 2008, 2009, after the crash. QE. And what is QE? QE is nothing more than making sure we can drop rates down to zero, and so the banks can drop their rates, and that way give people an incentive to start buying stuff now that they ordinarily would put off. A good example I used on my radio show was if a guy's retiring 5 years out, his dream's to buy a boat, and all of a sudden, he starts seeing, wait a minute, look at these boats. God, look at the payments are really nothing. I'm going to go down to that boat yard and buy the boat now rather than 5 years from now. When he goes down to the boat yard, there's 100 boats there. All of a sudden, at the end of the week, there's only about 7, 10 boats because everybody has the same idea. But they can't replace those boats. So the few boats that are remaining, they move the price up. Pulling all this demand forward starting 2008 under QE used to be a crime. That's right, used to be. Okay, Reagan changed that. But when you pull that demand forward, that's when you're creating inflation. That's where the inflation started. This is where the inflation was added in the pandemic. So now you had a double whammy. So the market, the market, remember, the reason why the market couldn't continue going higher, because what pushed the market up since 2008 was the tech stocks because of the low rates. But the tech stocks, remember, they stopped rallying in 2013. I'm sorry, not 2013, but right here. They stopped in November, right there, 2000. Right, 2021, right there. They stopped rallying. They wanted to continue to go up. And they said, well, all we have to do again is print money, drop interest rates to zero, and we'll continue just like we did here. Okay? That big rally we had here. They can't do it. They couldn't do it. Because if they printed more money and they did that, then gasoline would be at $4.75, gasoline would be at $6.75. 30-year fixed-rate mortgage would be at 5% now from, remember, just 9 months earlier, 2.5%. We'd be at 8, 9, 10%, maybe even 15%. So the market's been dropping. So the evidence that it's not going to just all of a sudden, we're going to have what we call relief rallies, but we're not going to reach this top again, either in the S&P or the NASDAQ, and here's the proof. We have what we call, right here, this is the VIX Index. The VIX Index tells us when the bottom is going to be in. If you look at this chart from, we're around that a little bit above 30%. See this 40 right here? This is the 2008 crash. Every time it gets up to 40, this is the fear. This is fear meter right here. When people get fearful, right, the market crashes. And that fear, when you hit 40, that's when, notice how this rally, this is when the crash occurred in 2008. 2020, when we hit 40, right here, that pandemic crash. And after the crash, the bottom's in. But you got to have the crash to have the bottom in. We're right here right now at 30, heading towards this 40. That's why you see every day the market going up and down, up and down, up and down, because there's less and less and less buyers. So that's why you get that big volatility during the day, up 300, down 200, up 300, down 200. Until we get this spike, until it hits 40, the bottom is not in. It's just a fact, okay? And the other fact is the bottom's not in because if you take a look at this chart, what we call breadth, there's only 17% of the S&P 500 stocks above support, the 50-day moving average. There's only 29% above the 200-day moving average. When you have a rally like this, nice and strong, it has to be at 70% to have a rally like this. We're at 17 and 29, far away from 70%. I hope you enjoyed this information. I hope it helps you in your trading. And remember, hit subscribe, like, and share. And also, you can join my gang free for 10 days. And I think we can help you. Don't look at the market going down as something bad. Look at the market going down as something good, because you can make money with the market going down by shorting it. Let us assist you in shorting. I'll see you on the charts.